Your life is now priced by a hidden score. Okay, so here's the thing. Most people think risk is about credit files and FICO. But your life now gets priced by a hidden, real-time score built from behavior. It changes as you move, browse, buy, and sleep. It's not regulated like your credit report, and you don't get an adverse action notice when it dings you. That's the shadow score. What feeds it? Alternative data. Your phone number, your device ID, your email graph, your app list, dwell time on pages, late night activity, battery patterns, location pings that say you commute long, hit a certain bar, or visit a payday lender, purchases, subscriptions, chargebacks, the MPL history, telematics from your car, even address stability and phone tenure. It's all fair game. Who stitches it? Data brokers like LexisNexis Risk Solutions, owned by RELX. They run products like RiskView and RiskView Spectrum that pull in utility payments, phone bill timeliness, public records, and device graphs to guess your stability. They link your phone, past addresses, emails, and IPs into one persona. Then sell risk signals to insurers, landlords, and employers. You never see the file that matters. How does that hit your wallet? Dynamic pricing and risk tiers. Same product, different price because the model thinks you're a higher loss risk or a higher churn risk. Auto insurers plug into telematics exchanges and claims databases to nudge your premium. Landlords run tenant screeners like SafeRent Solutions, formerly CoreLogic Rental Property Solutions, to spit out an approve/decline in seconds. Marketplaces and property managers feed those outputs straight into deposits and fees. You're risky, so you pay more now. Private equity loves this. They roll up data brokers, screening tools, and pricing software into bundles they can cross-sell across housing, insurance, and hiring. It's neat for them. Each layer makes more when your tier inches up. Higher premiums, higher deposits, more add-on fees. And because the models sit outside old-school credit laws, visibility stays near zero. You feel the cost, but you can't point to a line on a report and dispute it. Why don't you see it? Consent is buried in cookie pop-ups and terms you skip to use a map, book a ride, or pay a bill. App SDKs vacuum metrics by default, then pass them to partners, who pass them to exchanges, where they get hashed and anonymized, then quietly reling to you through your device, email, and address history. If you asked for your credit file, you'd miss the real pipeline because it doesn't live under that label. Early signals are everywhere if you look. Rental screenings now decide not just yes or no, but the size of your deposit, the pet fee, even conditional approvals. Usage-based insurance started as a discount if you drove safely, then turned into midterm premium hikes for hard-braking and late-night trips. The NPL limits dip after too many returns or cart abandons. Airline fares nudge up after repeat searches. You don't get a letter explaining any of it. Now you might be thinking, isn't more data fairer? That's the pitch. But here's where it gets interesting. Many stability proxies recreate bias without naming it. Zip code correlates with race and income. Commute patterns signal class and shift work. Frequent moves can mean you're young, divorced, or priced out. Not that you're unreliable. New phone line. That might be a cheaper plan, not fraud. The model doesn't care. It sees higher loss odds in the training data and taxes you for the pattern. And the training data? Labels come from past claims, evictions, court filings, chargebacks, and approvals that were already shaped by older biases and errors. Screeners like SafeRent learned good tenant from landlord outcomes that include noisy eviction filings, many dismissed or settled. Insurer loss data can reflect who gets policed, who reports, and who has coverage. Feed that into a model, tighten thresholds via API, and you lock in a feedback loop. The risky get priced out, so the risk seems to validate itself. Let me give you a quick micro-story. Last week, someone told me their rent, quote, jumped after they reapplied to the same building. Same pay, same job. The only difference, they'd installed a free budgeting app that linked their bank. Within a month, they saw more pre-approval spam and got a conditional approval for the apartment with a fatter deposit. Coincidence? Maybe. But that's how the shadow score feels. Death by 1,000 tiny maybes that add real dollars. So what's the bottom line? You're living inside a risk market you didn't join. Your habits are inputs. Your prices are outputs. The model updates in the background. And because the rules were written for FICO-era files, not phone-era exhaust, you're exposed. The longer you wait, the more history that score can lean on, and the harder it is to move your tier. You need to know this. It's not about turning off your phone and hiding. It's about breaking the data links that inflate your tier, forcing human review when it matters, and using new rights where they exist. We'll hit the playbook soon. First, we need to see how fast this scaled and who's cashing in. Urgency, the speed run from niche to normal. Everything changed when smartphones turned into sensors. In the early 2010s, AdTech learned to follow you across sites and apps. FinTech looked over and said, wait, those trails can price risk. That's the pivot. Ads met underwriting. And once data got cheap, models got bold. What started as show better ads became decide who pays more. Then the pandemic hit and stepped on the gas. Contactless everything. Delivery for basics. Telemedicine. Remote signups. Telematics devices in cars. Every yes, to keep life moving normalized constant tracking. Risk teams got a fire hose of new signals. Habits hardened. The software stayed. Now, this is important because the cloud turned pricing into a plugin. You don't need a giant in-house team. A landlord on RealPage, a mid-size insurer, even a marketplace can hit an API for loss odds or a rental risk band. Third-party models, often fed by exchanges like LexisNexis Risk Solutions, slot into forms you already fill. Flip a switch, and behavior-based pricing is live by lunch. Regulators lagged because the guardrails were written for a different game. Old laws protect credit files you can request and dispute. Shadowed data, device IDs, hashed emails, app signals, sits outside those buckets. So institutions leaned into the gray. It's not a credit decision, it's a risk adjustment. It's not denial, it's a deposit. Language games beat the clock. Network effects did the rest. More clients feed more outcomes back to the model. More outcomes sharpen thresholds. Sharper thresholds attract more clients. Rinse, repeat. The bigger the exchange, the more it looks indispensable. A landlord thinks, everyone uses this score, I'd be dumb not to. An insurer thinks, competitors price by telematics, I can't ignore it. Adoption snowballs. Meanwhile, your personal cost curve creeps. A few bucks on a fare here, 10 on a fee there, a 5% bump at renewal, a conditional approval with an extra month's deposit. You don't see a cliff. You see a slow, quiet tide. And that's the trick. Death by small deltas you won't fight one by one. Quick micro story. A rideshare driver told me their net dropped even though rides were up. Why? Insurance telematics flagged late night shifts and hard braking in city traffic. The midterm premium rose. No crash, no claim, just behavioral lines crossed. They switched carriers, same thing. The exchange data followed them. That's how fast niche pilot becomes standard. But here's where it gets interesting. Private equity didn't just invest, they bundled. By a screening tool, by a pricing engine, by a data feed. Tie them together and sell precision across housing and insurance. Cross-sell means lower sales costs and higher margins. And because the value shows up as a small uplift on millions of people, it looks like free money. For them. For you, it's a tax. Academic and policy chatter focused on algorithmic pricing in retail, airlines, rideshare, Amazon. That's real. But the quiet shift was in approvals and premiums. Not just what you pay, but whether you get in the door. Once eligibility and price move together, a borderline risk band isn't a soft nudge, it's a wall you can't see. Isn't this safer for everyone? That's the sales line. Lower losses, fewer defaults. Sure, losses drop on paper when you price people out before losses happen. But safety for whom? If a model marks your zip as riskier, the block pays more, leaves, or stays underinsured. Those outcomes feed the next training round. The loop tightens. Now remember this number, 30. That's roughly how many seconds it takes a modern tenant screener to hit your history. Compare it to millions of past approvals and spit out an answer. Fast is good, right? But speed hides error checking. Court records mismatched? Eviction filed then dismissed? Too bad. And the culture shifted. Personalized pricing sounds slick to boards and investors. It also lets firms test boundaries at scale. If pushback spikes, they roll it back. If not, they keep it. That ratchets markets toward whatever the model can get away with. Not illegal, just relentless. So, where does that leave you? In a world where opting out is work and staying passive is costly, the run from niche to normal already happened. The goal now isn't panic, it's leverage. Break links the model relies on. Force events that require a human. Use laws that finally exist in some states to pull your file and say, Show me. Because the sooner you cut the feeds, the sooner your tier stops drifting up while you sleep. The adversary map. Who's scoring you and why? Let's name names because clarity is power. At the base layer, you've got data brokers. LexisNexis Risk Solutions, owned by RiskView, is the heavyweight. They build giant identity graphs that link your phone, emails, past addresses, utilities, court records, then layer affinities from third-party app and location data. Their RiskView and RiskView Spectrum scores turn that mess into risk bands. Stability, ability to pay, likely loss. Axiom plays here too. So do TransUnion's TLO and Equifax's alternative data units. These folk don't just sell files, they sell decision fuel. Now the screeners. SafeRent Solutions, formerly CoreLogic Rental Property Solutions, sits between you and a lease. Landlords punch in your info. SafeRent returns a score or a straight, accept/decline/conditional. First advantage and check or run hiring screens with risk signals. They brag about speed. Seconds, not days. That speed is the point. It moves landlords and employers from review context to trust the flag. And when the flag says risky, your options shrink. Insurers and underwriters are next. Think LexisNexis Telematics Exchange, where driving data flows, and CLUE, the big claims database. Add models like Attract. They score drivers off braking, speed, night driving, and where you drive. Property and renter models blend claims history with device data and address signals to set rates or caps. You won't get a letter saying your commute after midnight raised your premium, but the number shifts anyway. Then come the landlords and marketplaces. RealPage and Yurdi power huge slices of the rental market. Their approval systems plug into screeners and risk models, then push outcomes into deposits, pet fees, and monthly convenience charges. Marketplace platforms, vacation rentals, gig apps, run their own trust scores and tie those to fees and access. The logic is simple: higher risk, higher friction, higher price. Here's where private equity changes the game. Firms like Thoma Bravo, Providence, and Vista buy slices across this chain. A data source here, a screening engine there, a pricing optimizer up top. Bundle them, cross-sell them, and you've got an end-to-end stack that captures your data, scores it, sets your price, and closes the deal. Fewer vendors for the enterprise buyer, more margin for the roll-up. And each layer gets paid a little more when your tier clicks up. Why are incentives so tight? Because every node profits from precision, real or imagined. Data brokers get paid for coverage and predictive lift. Screeners sell fewer evictions and faster fills. Insurers tout loss ratios. Landlords point to lower defaults and faster leasing. Private equity counts steady, compounding SaaS revenue. Nobody's paid to build an appeal path for you. Everyone's paid to reduce friction, which means automate the no. Okay, but what actually informs those decisions? Identity linking is first. Hashed emails, mobile ad IDs, phone numbers, IP clusters, all stitched into a single persona. Public records and utilities lock it in. Then come behavioral slices. App lists, session times, late-night logins, scroll depth, chargebacks, returns, skipped payments, and address tenure. Location data adds context. Commutes, store visits, liquor or gambling stops, payday lender proximity. They don't need your name on every row. The graph does the work. Two more players you rarely see. Third-party SDKs and free apps feeding data upstream, and cloud API gateways that let mid-size firms rent a risk brain. That's why this spreads so fast. A landlord doesn't code a model, they call one. A mid-tier insurer doesn't build a telematics network, they buy exchange access. A marketplace doesn't curate signals, they embed a vendor's scoring block. Your behavior moves quietly across all of it. Alignment across layers is the quiet threat. As stability, hit from one product becomes a higher deposit through another, then a premium nudge from a third. No single move looks outrageous. Together, they trap you in an expensive lane. And because each system claims proprietary model, there's no one desk where you can say, prove it. Now zoom out. Who's scoring you? Data brokers that build the persona. Screeners that turn it into eligibility. Insurers that turn it into premiums. Landlords and platforms that turn it into deposits and fees. PE-backed stacks that synchronize the whole thing. Why? Because precision pricing prints money at scale. And because the law still treats much of this as outside credit, they can avoid the disclosures that real credit needs. Most people think they can out-nice this with perfect behavior. But the real secret is, break the links. If they can't stitch you cleanly, the score loses power. That's where we go next: what they collect, how they stitch it, and how to cut the cord. The data pipeline: what they collect, how they stitch it. All right, let's pop the hood. If the score is the price tag, the pipeline is the assembly line. It starts with identifiers. Your phone number is the spine. Your email addresses, old and new, sit right next to it. Add device IDs from your phone and tablet, cookies from sites, and your IP history from home, work, and coffee shops. LexisNexis links those to public records, utilities, and government files. That's how you becomes a stable identity, even if you switch emails or use private browsing. The phone and address graph ties it back. Then the behavior stream kicks in. Not what did you say, but how did you act? Dwell time on pages, how far you scroll, which apps you open at night, battery patterns that hint at heavy use, session length. RiskView style systems love stability signals. How long you've had the same phone number, how often you change addresses, how recent your utility payments are. Pay your phone bill late twice? That pings a stability bucket. Swap numbers after a breakup? The graph tags new line, and that can look like volatility. Location is a whole other lane. Geofencing SDKs in free apps ship coordinates upstream. Those points get snapped to places: your commute route, your gym, a liquor store, a payday lender, a casino. One visit doesn't matter. Patterns do. Weekly stops near a gambling spot join affinities that some models map to loss odds or churn risk. Late night driving routes raise auto risk tiers. Live near a flood zone? Property pricing watches that too, even if you're uphill. Purchases rounded out. Debit and credit, exhaust, leak in through partners. BNPL checkouts, subscriptions you start and cancel, chargebacks you file, return rates, the gap between paydays and big buys. RiskView Spectrum-style products plug transaction history into charge-off predictors. They don't need your full statement. Signals like frequent small dollar BNPL or multiple trial churns feed a profile of financial strain. Pair that with address tenure, and you've got a neat proxy for stability without touching a FICO file. Where do the signals come from? SDKs and apps you barely use. Weather, flashlight, wallpaper, coupon, cleaner apps. Many ship device and location data by default. AdTech partners anonymize by hashing emails and IDs, then pass them to exchanges. Exchanges map hashes back to identity graphs through match keys like phone and address. That's the trick. Data can be anonymous in transit and still become you once it hits the broker that holds the keys. Linking is the glue. Hashed emails meet maids. The mobile ad IDs your phone broadcasts unless you kill them. Those meet IP addresses. Those meet your home router, which meets your cable account, which meets your name. LexisNexis brags about coverage because it fuses public records, deeds, liens, licenses, court filings with private feeds like utilities.